I'm watching something break in real time, and I need you to see it before the morning headlines bury it under the usual noise. My name doesn't matter, but my access does. I've spent 12 years as a private commodities analyst, and I built this channel, Veiled Wealth. For one reason, I was tired of waiting half a day for Bloomberg to report what I had already seen on my terminal at 2 hours in the morning. And frankly, I was tired of watching all these AI avatar channels pump out garbage silver content with fake urgency and zero data. So here we are. You're getting the real feed, unfiltered. Because if you're stacking physical or trading futures, you deserve to know what actually happened last night while you were asleep. Here is what I am looking at right now. Silver spot price, $87.59, down 5%. Down $4.61 from where it closed yesterday. That is not the story. The story is how it got there. Around 10:40 p.m. last night, Eastern Time, someone dumped approximately 2,000 futures contracts into the COMEX order book during what traders call the empty hours. This is the low liquidity skeleton crew shift, the overnight bridge between the New York close and the London open. It is the specific window where a relatively small amount of selling pressure can create a disproportionately violent price move because there is nobody on the other side of the trade. And that is exactly what happened. Silver got hammered from a $92 high down to $87.59 in what can only be described as a vertical line on the chart. Now, if you are new to Veiled Wealth, you might be thinking, okay, so someone sold, markets go down. What's the big deal? Here's the big deal. While paper silver in New York was getting slaughtered, physical silver on the Shanghai Futures Exchange was trading at $100.59 per ounce. Not 87, 100. That is a $13 premium. That, Tim, is the widest gap between Eastern and Western silver pricing in modern recorded history. So let me ask you the obvious question. If silver is really worth $87, why is someone in China paying $13 more for the exact same metal? And if silver is really worth $100, why did New York just crash it by 5% in the middle of the night when no one was watching? The screen is lying to you, and the reason why involves a desperate move by some of the world's biggest banks to keep a lid on something that is already broken loose in the East. Here is what I'm going to do in this video. First, I'm going to show you the exact data from last night, S price action, the volume, the timing, the levels. Then, I'm going to teach you about a market condition called backwardation, which is flashing red right now in silver, and is the single most important warning signal you can get in a commodity market. After that, I am going to run the math on this $13 Shanghai arbitrage and explain why it isn't closing, which tells you everything you need to know about the physical shortage. Then I'm going to address the skeptics, because there is always someone who says this is just a healthy correction, and I want to steal that argument before I dismantle it. And finally, I'm going to tell you exactly what I'm watching and what my personal plan is going into. Friday, eczettłness close, because by Friday afternoon, we're going to know whether the paper wall holds or whether this thing finally cracks wide open. Let me give you the hard numbers first, because everything else builds from here. I was looking at the data a few hours ago. January 14th, around 10:40 in the evening Eastern Time, silver spot price $87.59. That is a drop of $4.61 or 5% from where we were trading earlier in the session. For context, gold was down less than 0.5%. The dollar index we don, T, have the exact print, but based on the relative weakness in metals, we can assume it was relatively stable. So this wasn't a risk-off event. This wasn't some macro shock hitting all commodities. This was surgical. This was targeted. And it happened in the lowest liquidity window of the entire trading day. Let me explain what I mean by empty book. The COMEX futures market trades nearly 24 hours, but volume is not evenly distributed across that time window. The heaviest volume happens during New York trading hours. By 10 p.m., you are in the overnight session. Liquidity is thin. There are fewer market makers, fewer institutional traders, fewer counterparties willing to step in and absorb large orders. It's like trying to sell a house at 3 in the morning. You might find a buyer, but you're not going to get a fair price because there's no competition. So when I see 2,000 contracts hit the tape at 10:40 at night, I know exactly what is happening. Someone is not trying to get the best price. They are trying to move the price. 2,000 contracts is 200,000 ounces per contract. So we are talking about 10 million ounces of paper silver being sold in a single coordinated wave. And because the book is thin, that selling pressure doesn't get absorbed. It cascades. It triggers stop losses. It forces liquidations. Now here is where it gets interesting. While New York is printing $87, I'm watching the Shanghai Futures Exchange. And physical silver over there is trading at $100.59, a $13 spread. I've been doing this for over a decade. and I have never seen a premium that wide between east and west. The normal spread is maybe 50 cents. $13 is not a spread. It's a chasm. It's a market dislocation. And here at Veiled Wealth, we believe it tells you that the price discovery mechanism has completely broken down. In a functioning market, arbitrage should close that gap almost instantly. If silver is 87 in New York and 100 in Shanghai, traders should be buying in New York, shipping the metal to Shanghai, and selling it there for a $13 profit per ounce. That arbitrage pressure should bring the prices back into alignment within hours. But the gap isn't closing. It's been sitting there. And the reason it is not closing is because there is no physical metal available in the West to buy and ship. The vaults are either empty, or they aren't willing to release inventory, or there are delivery delays being blamed on logistics. Whatever the excuse, the result is the same. The paper price in New York is meaningless if you can't actually get the metal at that price. That brings me to the third critical data point, backwardation. The silver futures curve has inverted. Spot silver, meaning immediate delivery, is trading 30 cents higher than the March 2026 futures contract. That might sound like a small number, but in commodity markets, it's an earthquake. In a normal, healthy commodity market, the futures curve is in what's called contango. That means prices for future delivery are higher than the spot price. This makes sense. If you are going to store silver for 3 months, you have to pay for the warehouse, insurance, and capital carry costs, so the future price includes those costs. When the curve inverts, when spot is higher than futures, that is backwardation. It means the market is screaming for immediate delivery. It means buyers are so desperate for physical metal right now that they are willing to pay a premium to skip the line. They don't want a contract for March. They want the metal today. Imagine a concert ticket. A ticket for tonight costs $500. A ticket for next year costs $300. Why? Because people are terrified the band won't be around next year. That premium is backwardation. It is the market pricing in scarcity, urgency, and fear. So when I see silver in backwardation, I'm seeing a market that doesn't trust the system anymore. I'm seeing buyers saying, I don't want a paper promise. I want the metal in my vault today. Now let S talk about the big players, the bullion banks and market makers who are short silver futures. If you are short a March contract and the market is in backwardation, you have a massive problem. Normally you could roll that position forward and collect a credit, but now rolling forward costs you money. And if you try to deliver physical metal to satisfy the contract, good luck finding it at $87 when the Chinese are paying $100. So what do? You smash the paper price. You dump contracts into the overnight session to drive spot below $88, hoping to shake out the weak hands and scare retail buyers away from taking delivery. That is exactly what we saw last night. This wasn't profit-taking. This was a coordinated effort to defend a price level, and I'm going to tell you why that price level is so important. Let's talk about the unverified rumors. Here at Veiled Wealth, we deal in data, but you need to know what the whisper numbers are. Rumor 1, the options trap. There's a theory that banks are shorting to keep the SLV ETF below $80 by Friday. There's a massive amount of call options on SLV expiring this Friday with an $80 strike price. If SLV closes above 80, those calls go in the money, forcing market makers to buy millions of ounces to hedge. Rumor 2, force majeure. The rumor is that some big Western vaults are considering invoking force majeure clauses to delay physical deliveries because they simply don't have the metal. Rumor 3, the Mexican holdout. Major Mexican silver miners are allegedly withholding supply until prices hit $100, effectively starving the market. I tell you these not because I believe them all, but because they explain the panic we are seeing in the order book. There is always the skeptic who says, silver ran from $80 to $92 in 48 hours. A 5% pullback is healthy profit-taking. Here's why that is wrong. First, timing. Institutional profit takers don't dump 2,000 contracts at 10:40 p.m. into an empty book. They scale out during liquid hours to get the best price. This was a dump designed to hurt the price, not maximize profit. Second, no macro trigger. Gold didn't move, copper didn't move, the dollar didn't move, only silver crashed. That is not a market correction, that is a hit job. Third, the Shanghai spread. If this were a real correction finding a new equilibrium, arbitrage would close the Shanghai gap. It isn't. So what am I doing? Friday is the line in the sand. Here are my triggers. First, the $83 level. If silver dips to 83, I am looking to add to my physical holdings. That is key support. If we test it and hold, the bull market is intact. I'm buying bars, not paper. Second, the Friday close. I'm watching the $80 level on SLV like a hawk. If we close above 80 on Friday, I expect extreme volatility Monday morning due to that gamma squeeze potential. I am not chasing it, but I am holding tight. Third, the backwardation spread. Right now, it is at 30 cents. If that widens to 50 cents, if spot starts trading 50 cents higher than futures, I am ignoring the screen price entirely. At that point, the paper market is a fantasy. Let me be clear, I am not panic selling. I have been through enough of these cycles to know when a pullback is real and when it is manufactured. This one smells manufactured. The volume was wrong, the timing was wrong, and the physical market in China is calling the bluff. The banks are in a lose-lose scenario. If they let the price run, they lose billions on shorts. If they suppress the price, they accelerate the physical drain to the east and make the eventual squeeze worse. I built Veiled Wealth to give you the data before the morning news. You have the data now. The rules are breaking. The arbitrage isn't closing. The backwardation isn't reversing. Hold the line. Watch the physical. Ignore the noise. This is Veiled Wealth, and I'll see you on Friday.